Hello, chart watchers, and welcome to this Monday, January 7th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we start off a new week in 2019, and the market is green. We've got the Dow Jones Industrial Average currently up 199 points. The S&P 500 up 29. The NASDAQ up another 100, up 103.55. The Russell 2000 higher by 27 points. 10-year Treasury yield continues to move back in the right direction. Money rotating away from Treasuries, sending the yields higher. You can see the 10-year Treasury yield, after having a strong day on Friday, has climbed another 2.3 basis points to 2.68%. Volatility continues to decline, although not down much today, still hanging in at about 21. Leading the market to the upside, consumer discretionary stocks, including retail. We'll take a look at that in just a second. You can see the XLY having another very, very strong day. Energy also moving up on the back of strong crude oil prices. Communication services having a strong day, along with technology. So money is rotating in more aggressive fashion, which is bullish. Leading consumer discretionary, as I mentioned, the retail group, the XRT. This is a widely diversified retail ETF. You can see it up 3.37%, suggesting extremely strong action across many parts of the retail group. Home builders, don't miss out. This move is a pretty big one. We're going to talk about that in just a couple minutes, but we're breaking above the 20-week EMA right now on home builders. Of course, we got a long way to go to get to that Friday close and sustain that throughout the week. But home builders have been looking a lot better. I wrote about them a little bit this morning in my blog, and certainly a group to keep an eye on with rates so low again. Erin, it is the start of another week. Did you have a good weekend?
I had a great weekend, except for I had 2 hockey games, which is always great. But unfortunately, the Ducks aren't really doing that great. So it was 2 pretty big losses, but we always have a good time visiting with all of our friends around us. So it was okay. And then neighborhood party again, I'll tell you. Our neighborhood just popping and happening.
Wow, you got a rocking neighborhood.
Yeah, I love it.
Well, I watched football, of course, the NFL playoffs, one of my favorite weekends of the year. This past weekend and next weekend, because it's 4 games. I just kind of live in my own little world watching football throughout the entire weekend. But being a Redskin fan, I was really anxious to see the Cowboys and the Eagles get sent home. And unfortunately, they both won. So we had similar weekends. We didn't do very well.
Yeah, I guess I should pay more attention to the NFL, though, since both of the LA teams are doing quite well.
That is true. Actually, the Rams are strong. They're going to have a tough game coming up against Cowboys because Cowboys playing well. But I think the Rams look pretty good. And
Chargers look good.
Yeah, I think the Chargers are going to go to the Super Bowl. That's my prediction. I think they're going to win 3 road games and go to the Super Bowl.
Wow. I know my husband would be very happy about that, as he is a San Diego fan. So,
well, how about Phillip Rivers versus Drew Brees in the Super Bowl? I think that would be
that would be a really great combination to watch.
Yeah, no doubt. All right, what do we got going today?
I know. There is the stock market, isn't there?
There is.
Okay, well, our upcoming schedule next, actually this week, wow. We have Greg Schnell coming back with us Wednesday. Greg Morris, the Gregs this week. Greg Morris will be joining us Thursday. And then on Friday, we do have Grace and Rose coming in. So that'll be a great show as well. Today's agenda, we're going to start off with Monday setups. It is Monday. Follow that up with an earnings spotlight. John Hopkins is here from Earnings Beats for that. 10 and 10. We're going to do HP first, not Hewlett Packard, the other one. Sentiment update will finish it off. I'll be showing you some of the sentiment numbers that have come in and what those implications could be. All right, let's get started. Technical news and headlines.
Yeah, we had quite a bit going on in terms of economic reports. We had a couple today, but the first one, as you see on your screen there, November factory orders, was affected by the government shutdown. So that estimate is what we were looking for this morning, but unfortunately, because of the government shutdown, we have no actual number. And I think that was the same last week with construction spending, I believe was the report that was affected. But at 10 a.m., we did get the December ISM non-manufacturing index out, and that showed a slowing, 57.6 versus 58.4 expected. It's also notable that I believe it was the November ISM non-manufacturing index that was 60. I know it was over 60, and I want to say 60.7. So that's a pretty big drop from one month to the next. kind of signaling a little bit what we've been talking about, the huge slowdown, the big drop in the market in November, especially in December, and some of that goes along with it, the Apple warning, and some of the other areas of the market that have been hit pretty solidly. But as we take a look at the 10-year Treasury yield, I'm going to take a view of it on a 10-day, 10-minute basis. So this is an intraday chart of the 10-year Treasury yield going back since just before Christmas time, December 21st. And this looks like a bottoming head and shoulder pattern to me, with the left shoulder reaction high back up here to about 2.67, 2.68. Go down, put in the head, the reverse head, come back up. Here's your reverse side of the neckline on the right side. There's your reverse right shoulder. And now we're breaking out. If that's the case, this would measure from 2.67 down to 2.55 or thereabouts. I'm going to say up to about 2.79 or so, which would take us almost all the way back up here to where we had that huge gap down on December 27th. If that happens, that suggests that money is rotating out of treasuries. That's what sends the yield higher. And that money coming out of treasuries could continue going into the stock market. So that's going to be something that we're going to want to keep a really close eye on as we move forward. Speaking of the stock market, there were no earnings out this morning of any significance. So what I thought I would do is start off by talking a little bit about the Chart Watchers newsletter, which was out over the weekend. There was a number of really, really good articles. You want to check that out if you haven't already. And also be sure to subscribe. It's a free subscription to the Chart Watchers newsletter. It comes out first and third Saturdays of each month, and gives you a lot of pretty solid commentary, I believe, in terms of technical analysis and how each of us on the newsletter views what's going on. I did want to talk a little bit about my article first thing today, because as I look at the market, of course, when you look at the intraday, day-to-day action, it's incredibly emotional because of the volatility back and forth. So I wanted to step away, and I went back and did a lot of research, and first just pulled up this 100-year quarterly chart on the S&P 500. And I want to kind of show you the history of the stock market. Now, maybe things will be completely different this time. This is only a guide. It's certainly not a guarantee. But when I look at the stock market, I kind of look at it like a chart of an individual company. I mean, a company that's growing, and the U.S. economy grows year after year for the most part. We go through recessions from time to time, but by and large, our economy grows. And so when you look at the S&P 500, it's really a report card of what's been going on in our economy and our companies here in the U.S. And when you take a look at it, of course, this is all the way back to 1929 throughout the 30s. This was an awful period for equities. Once we broke this double top back in 37 and 46, and we got through that World War II, we went off into a secular bull market, which lasted 18 years, from 51 through about 68, 69. Now, if you notice, there were pullbacks along the way. These are referred to as cyclical bear markets within a secular bull. So you got a secular bull, cyclical bear. So these are short term. They don't last very long. They come back down. They scare the heck out of everybody, but then you just simply power higher. 70 or 69 through the early 80s, let's call it 81, 82, we were in a secular bear. You can see two very sharp moves to the downside. In between, we did have a decent rally, but the second one here at the bottom took out that prior low. It was just ugly. It was an ugly period to be involved in U.S. equities. We ended up breaking out in the early 80s, and it started a secular bull market that lasted 19 years. Since then, starting in 2000, I want you to take a look at this setup, very similar to what we saw in the 70s. Bear market, a deep bear market, followed by a bull market, followed by an even deeper bear market. And so we had a lost decade, lost really dozen years, 2000 to 2012. We went nowhere during that period. That is a secular bear market. Now in 2013, we've broken out. Now, is this secular bull market going to be different than these last two? Is this one where we just going to collapse and go back down to the breakout area? I mean, we never really saw that in these prior moves. We just took off. We had cyclical bear markets within these moves, but we did not have a deep bear market. So when you look at what we've just experienced over the last few months, you might be saying, well, this is the start of something really big. I don't think that's the case. I don't think that we're done. I think it's possible that we're done and we've seen a bottom, but I still think there's probably better than a 50-50 chance that we have another push to the downside. So I wanted to take a look at some charts. Going back, this is in 1998. This was the last cyclical bear market within a secular bull market that we had. 1998, that was, again, if we go back over here, you'll see this was the drop. So on a long-term chart, it just looks like a little blip. But if you were in it at the time, you probably did not feel like it was a blip. We went from 1190 down to 923. We lost 22% in 3 months. Bear market, more than 20%. So there was the big drop. Now, on the first move down, look at the VIX. VIX was up, in this case, up into the low 40s. We had a bounce of 14% to go back up into this area of prior support. That becomes resistance. Came back down one more time, put in that double bottom, and then took off to the upside. We may see something like that again. Let's go back to the next cyclical bear market, which was 1990. Remember, this again is in this longer term secular bull. This was back in 1990. This is this little blip that we saw. So if we take a look at this one, we dropped from 370 down to, I don't know, 293 or so. We lost 20%. This lasted 86 days. The one I just showed you in 98 lasted 80 days, and the one I'm about to show you in 1987 lasted 101 days. So we're talking about, 2 to 4 months. These cyclical bear markets lasted within these longer term secular bull markets. But here you can see off of the breakdown in 1990, we did come back up, and we rallied about 7% off of that initial bottom. The other one was 13, 14%. I'm going to show you one more. This is the 1987 crash, where we were at 330. We went all the way back down below 220, had a huge drop. We lost 33.5%. Didn't last very long. And look at the initial rally. This rally came back up 20% from the bottom. I mean, technically, this was a bull market at this point. Right after 2 days after it was a bear market, it was a bull market because we rallied 20% 2 days. I don't know that I buy into that theory, but it did actually mark a bottom, and we did resume that long-term secular bull market. The whole point of this is, don't assume that this bear market is necessarily the same as the bear markets we saw 2000 to 2002, 2007 to 2009. We got panic, we got impulsive selling, we saw breakdowns, but the longer-term, big-picture secular bull market remains in play. I would be really careful about just having tunnel vision and only thinking this market can go down from this point forward. I do think we're going to go down one more time. I believe we may hit a bottom later in the first quarter, maybe even into the second quarter, but I think we're going to finish strong, and I believe we're going to be at 3,000 on the S&P 500 a lot faster than you might think possible. Anyhow, that's what I see there. Now let's take a look at the crude oil prices. This is not going to reflect today's action. Crude oil is up again today. Last time I looked, it was over $49 a barrel. You can see it closed on Friday, just under 48. So it is making a breakout. We had lower lows and higher PPO. That to me tells me 50-period test is possible. A lot of congestion between $50 and $53 on crude oil prices. That's where I think we're heading. That could be good news in the short term for the XLE, which continues to move higher. If I go back and show a longer-term one-year chart on the XLE, you will see that the prior support between 62 and 64 right in here was very strong until we broke down in December. So I think we're heading back to that 62, 64 area. You can see the decline in the 50-day moving average also right in that zone as well. A lot to think about. We'll be talking about all of this going forward. And I know plenty of folks do not share my opinion that this will be a shallow bear market, but I believe it's going to be shallow. I think it's going to be quick, and I think the bull market, secular bull market, will resume, and I think it's going to resume in 2019. Erin, what do you got for upgrades and downgrades?
All right. Let's see here. We had quite a few. I'm not going to be able to go over even nearly close to the amount that we had today, but I wanted to show you a few that I thought were interesting. Let's put it that way. So, all right, we're going to start off with advanced auto parts. And this one was upgraded. You can see that we're getting a really nice move off of a breakout that happened last week. And we're maintaining that support level at these lows that we saw back here in September. So I think this one's looking pretty good. You've got the 5 getting ready to cross above the 20. And of course, a really nice looking PMO with a buy signal coming in. Well, it looks like it will come in probably today. And that would give us, of course, a buy signal as far as momentum. And we could be looking at another leg to the upside for Advance Auto Parts. Adobe was upgraded today. And this one's getting ready to hit some really important resistance, and it's actually butting up right against it right now. There's a couple of issues I have with this chart right now. Number one is, if you look in the thumbnail, you can also see it in the main window. The 50-day EMA is really close to crossing below the 200. Now, of course, if price can get itself back above that 200, it's going to avoid that negative crossover. That negative crossover is something you don't want to see. As far as decision point analysis, when the 50 is below the 200, you're now in a bear market configuration for whatever it is you're looking at. And so for Adobe, if we get that 50-200 negative crossover, that means we have a long-term sell signal and it's set up in a bearish configuration. However, we are very close to that 200-day. If we can get a pop right up above that, that will of course get us above this area of overhead resistance, which I think is going to hold very strongly. But I am optimistic given the PMO buy signal that just came in. Another upgrade to look at, Micron was actually upgraded today. BMO Capital upgraded it from a market perform to an outperform. You can see that I got a PMO buy signal on this one as well. It's also hitting some very important resistance. I'm going to actually annotate this for us. I want you to see what is going on, and I want to see it more closely too. All right, so if we go from the intraday low back here at the end of October, we have actually punctured up above that overhead resistance. I think that's a good one to go for. You could, of course, come up a little bit to some of these other areas where we have it this low right there. And in that case, we're not quite trading above it. But I think we can lower it right about here to that 33 level. And we are getting that breakout. We are now trading above that, and look at the buy signal in oversold territory. I like that setup. However, caveat and warning, look what happened last time we got the buy signal on the PMO at almost the exact place. It comes up here, we got a little bit more upside, and then it fell apart. So we'll want to watch this closely. And this is an example of when you have that 50 below the 200, what can happen? You have some great setups. You might have a PMO or a MACD or a PPO looking great. But if you have that 50 below the 200, many times you're not going to get that bullish outcome that you want. So we're getting the breakout. I think that's positive, but you need to beware because we should expect bearish outcomes before bullish outcomes. But like I said, I think this one looks pretty good. 5 is getting ready to cross above the 20. Might be a decent short-term play on Micron. Alrighty. Another upgrade today, Pulte Group was upgraded. Look at this beautiful breakout. And we did get that buy signal. It looks like that came in off of that move that we got on Friday. It's looking pretty good. The PMO may appear to be overbought, but we have seen it get to these levels down here at -4, which means generally you're going to look for the opposite for the range of the PMO. So we likely have a range that would go all the way up to 4. So while this looks overbought, it's not really as overbought as it could be. I would say that it's moderately overbought at this point. Nice breakout. Of course, this one would be one we would call chasing if you got in. So you'd probably want to wait for that pullback, but look at that breakout coming above $27, which has been quite the area of support and then resistance that we got back here in November, December, but we got the breakout. All right, 2 downgrades I'm going to talk to you about. And here we are. Budweiser was downgraded today. And, I actually kind of like this chart. So, despite the downgrade, I think there might be a little opportunity here. It is in that Staples area, and I think that will continue to be a good area to be in if we continue to see the market fall lower as far as the bear market goes. The PMO buy signal came in. I think you could certainly make a case for at least getting up to this gap resistance right here, or the resistance that's posed by these two lows in October and November. So that would be the place to watch. But I think you could, get a couple percentage points off of a move in the very short term. Despite the downgrade, Snap was downgraded. And this one actually I thought looked pretty good. It's lost so much value. I mean, look, back in February, it was over $21, and we're now trading right around the $5 and $6 range. But we got a little breakout here that matches up with these lows that we saw back here in October and November. And I like the look of the PMO. You have declining price bottoms, but the PMO bottoms are rising. And you can see that this reading right now in the PMO is above that previous top. I think we might be able to get a little bit out of Snap here in the short term. So I think this one looks fairly good. Again, 50 is well below the 200, so we have to be very careful as far as our upside picks when we're sitting in a configuration like that. All right, I went a little bit too long. Sorry about that, but here are all the upgrades and downgrades. I'm not going to read them all off because, like I said, there are a ton of them. But, just to keep an idea in there, BJ's Restaurants, Cabot Oil and Gas upgraded. Spotify, we looked at Snap. Spotify was downgraded today as well. I thought that chart looked interesting, just didn't have much time for it. So, all right, I did get into our time for Monday setups, but let's get it started. I don't have anything that great to look at, to be honest. So it's just such a wishy-washy market in terms of, these big upswings and then a big downswing. It's just really hard to find the right picks for Monday setups. So.
Yeah, and we hadn't. Our last one was 3 weeks ago, so we hadn't been back. We haven't been here on Monday since it was December 17th, because we didn't have one Christmas Eve, the 24th, and of course then New Year's Eve we didn't have one. So this is the first time in 3 weeks. So we'll go over quickly the one that we had back from 3 weeks ago, and I think you had IDXX.
Yep, putting it in right now, and it was a short. And yeah, it was right in here in December. So obviously it's not turned out too good, but I think it was okay when we picked it. But yeah, not the best shorting opportunity, I don't think. But yeah, we're kind of, usually when we pick, we're looking at 1 week. So, and you were DXCM?
Yeah, and I tell you that what this shows, looking back over the last 3 weeks, because DXCM I had from a long perspective.
Mm-hmm.
Initially that first week, I think IDXX did very well on the short side, which was fine, and then DXCM struggled. Actually, to be honest, if I looked at this objectively, I didn't own it, but if I had looked at it objectively, I would have gotten stopped out of it after talking about it, because I think it was around 115, and it took out that triple bottom going back over August, October, and November. But the bottom came right at the prior highs in July of 2018. Those were the highs where we broke out from. We went right back down, tested that area, and the stock has rebounded $26, $27 from there. So again, if you get the direction of the market correct, it makes it a lot easier with your individual stock picks. So
Absolutely.
Yeah, keep that in mind. So DXCM's worked out well on the long side, but there was a lot of volatility since December 17th.
Oh, well, yes, absolutely. It's everybody got whipsawed around pretty well during the holidays. So not a surprise to see our charts looking the way they are from 3 weeks ago.
Yep. So what do you got for this week?
All right, let's look.
What are you going to do?
All right. Where are my Monday setups? There they are. All right. So I picked some kind of from wild areas. Mine are actually going to be on the, I hate to say long side. I'm going not for a short. Let's put it that way. I'm looking at upside potential. And the reason I am is in the shorter term, the very short term, I think we can see the VIX end up getting lower still, and I'm not getting quite the climactic readings. And as well, when I go over sentiment, you'll see that I'm looking for short-term upside potential right now. I know that sounds very strange from Erin the bear for the last couple of weeks or so, month or so. But in the short term, I think we're looking, there's some possibilities. So with that in mind, Denny's was one that came up in a scan. I did have some come up in a scan, and then I did just sort of pick a few from memory and some that I may have seen when I was going over my upgrade and downgrades. But this one did come up on a scan. And oh, just FYI, I ran my scan for dogs, meaning that, you know, where I'm looking for shorts. And I again came up with no results. So that's why I was like, okay, well, I'm not getting results on shorts, so let's start looking on the upside. So Denny's, this is one that I liked. I've got the PMO that is turned up above the zero line. It's getting ready for its crossover buy signal. You can see right here in the last week, really, we had some really great volume come into the upside. And, you know, it's been a little bit wacky here through November and December, but I think that we've got a move that could at least test that 1750, more likely the 1775 area back from this top. But certainly I think we could get to 1750 off of this, and that would be a pretty nice little move for Denny's. Let's see, Med Place Holdings was another one. And I really like this one. I almost made it my pick, but I opted not to, just because the PMO is looking kind of unsure. It's been bopping around, moving mostly sideways. I'm getting the buy signal, getting ready to come in off of this breakout, and you could make a case for a really short-term double bottom. So I included it as one of my choices, but you know, we're looking at a move over 4 3/4% on the day. But I think this one still looks pretty good, so I decided to keep it on my list. If you look back here at the lows from the summer and early fall, August to September, those lows are just now being taken out as far as price breakout goes, since we lost that support level back in mid-December. So I think that one has some potential. MedSpace. Rogers Communications. This came up on a scan. I thought this one looked interesting. You've got a 20-50-day EMA positive crossover along with a 5-20-day EMA positive crossover. And I like the look of that. And you can see that we are still sort of not quite up to the overhead resistance, though, at that $53 range. And so that was one of the reasons I didn't pick it for this week. This one might be a little bit more of an intermediate term holding if you wanted to go that direction. The PMO is turning up. I think it looks pretty good. You probably will get a move up to that 54 level if the market in the short term continues to look good. Spectrum Brands. This one was a very low volume one, but I did like the look of it. Again, look at the accumulation going on here since the end of December on this move to the upside. We're now coming up and hitting this gap right here. This gap resistance is, we're getting ready to come up and test that at the $51 level. So again, this was why I didn't go for this one as far as a Monday setup. I think it would be good on the watch list. You have a 5-20-day positive crossover, and I think we're going to close that gap. So that's what I'm looking for, is a closure of that gap and actually a move all the way up into that 70 range. So I mean, I'd be looking for a lot here. Given the situation of the market overall, I would definitely temper those expectations, as well as the 50 being well below the 200. So if we could get up there toward that, closing that gap, I think that would be positive. So I'm looking at that one as a Monday setup. US Cellular, I did come up with a lot of comm services in my look, my scans and my just what I was just perusing as I went along. This one I think looks great. United States Cellular, US Cellular. Again, look at the accumulation going on here. I like that. PMO buy signal is right now happening, and we'll have to see if it's there at the end of the close. And I think you could certainly look for a move just above that $58 range. But again, you've already had such a nice run on this. And honestly, it's looking a little bit parabolic here in the very short term. So that's why I didn't pick it. I thought the upside potential, I mean, while decent, it wasn't great. So I didn't pick that. The one I ended up was a telecom though. SKM. SK Telecom. This one's a little bit on the low volume side, and you can see it trades a little bit jumpy here. But rounded bottom, PMO just getting ready for the buy signal after bottoming just above the 0 line. And the only thing I'd be a little worried about here is a possible island reversal. But your 50 is nicely above the 200. I think you could expect some bullish outcomes. I would be looking toward that 28, 25, 50 level. That's where I'm going to be looking for it to get to by next week. If anything, at least to the $28 level. So we'll have to see how that works out, but that's my pick.
All right, so you're going with SKM?
Yes, and now I'm going to be very quiet for a while I get ready for sentiment.
Okay, well, let's take a look. First, before I get into my picks, I'm going to take a look at the S&P 500 and just kind of give you a little bit of an idea of why I'm looking at the market the way I am right now. So on a 1-hour chart, here I marked the top. This is when the Grinch gave his last policy statement. Oops, I didn't mean the Grinch. I meant Fed Reserve Chairman Jerome Powell.
Yes.
But this is where he came out, and this is, you can see the volume just accelerate to the downside. If you notice and hit this inspect button, and we go back here, we were at 25.82. Now, I don't know if you remember, but 25.81 was the closing low from back in February of 2018. So literally, we were sitting right at that level when the Fed gave their policy statement, and we went straight down. Now, as we move our way back up, I've talked about a few levels I'd watch. Number one was 25.32, which was the intraday support from back in February of 2018. So that would give us a little bit of overhead resistance as we came up. We hesitated there on Friday. We've broken above it. I think we're making a run for this 25.82, 25.81, 25.82 level. I'm looking for a reversing candle. If we get something where we're up, and especially if we go above 25.82 intraday, and then we come back and close weak that day, I'm going to be taking chances on the short side. That's the way I anticipate trading the market as we move forward. Now, if you look back, first, well, let's just take a look currently at the market. We're sitting here at 25.58. Is this, well, 25.60 is where we are right now. And these were the lows that I was talking about. Here was that intraday low. Here was the 25.81 close that we actually came back down and closed again right at that level. Here's the breakdown, and now we're rallying back up potentially to test that area. I think this is going to be critical. We'll see whether or not we can hold. If we do get through 25.81, I think there's a chance. If we do get through, then I think the declining 20-week moving average becomes a major obstacle, which is currently at 26.65. So that would probably leave us another 3%. If we can get through 25.82, I think the S&P might have another 3%, 2 to 3% to the upside. All right. If you go back, and again, I'm going to bring up some of these older charts, but this is the S&P going back to 98. This is the move back down. Here we came back up, tested the overhead resistance, went back down for a double bottom. If we take a look at 1990, we came back down, and you can see here we went up a little bit above the prior support area. So we went above price resistance, couldn't get through that 20-day moving average, and then fell back down. So just a couple of heads ups there that I think we need to be at least aware of. I think the VIX dropping back down to 20 already is somewhat bullish for the market. Back in 1990, you can see the VIX on this pop right here. The VIX only fell back down to about 27. And if I go back to the other one back in 1998, right here, when we made this rally, the VIX was unusually high back then, but you can see the drop here was only back to about 32. So the fact we're back to 21 on the VIX right now is a pretty good sign, but I'm not going to be overly excited until we can get back down below 1617, which was the bear market lows that we saw in 2000 to 2002 and 2007 to 2009. So here's my idea when I'm thinking about setting setups. I think we've made a huge rally. I think upside is limited, especially if we roll back over. So I am sticking to the short side. This is unusual. Aaron's going long. I'm going short. But here, let me go ahead and go through some of these stocks. My pick for the week is going to be Nautilus NLS. Here you can see the stock clearly broke down, a lot of distribution, big volume. It's coming back up, testing the 20. I would keep a tight stop if the S&P does break out and continues moving higher. This one certainly could do the same thing. 20-day moving average right now is 11.25, so you can keep a fairly tight stop. Intraday, you might want to give it some room above the 20, but a close above the 20 would bother me. I think it could go back down and test that recent low at $10. So I'm going to take NLS on the short side at $11.18. A couple of others I'll go through pretty quickly here. CF Industries Groups. Coming up, I'm looking for reversing candles now. Keep that in mind. We're breaking through the 50-day moving average. I'm not interested in shorting it here, but if we fail and leave a long tail above, come back down below the 50, I think CF would be a short. XPO, which is XPO Logistics. A lot of the logistics, transportation services, those stocks really got hit hard in the fourth quarter. XPO, in addition, ran into some other claims of fraud against their president and so forth. I don't know that I'd go along with all that. But anyway, the bounce here is now back to the 20-day moving average. Again, if we go through the 20 intraday and fail and come back down, or if we close above it today and tomorrow you see a reversing candle and we go back below the 20, that's when I would be interested in the short here. CDEV, same thing. All of these are going to look very, very similar. And by the way, every one of these companies missed earnings expectations in their last quarter. They missed on their top line, missed on their bottom line, and you can see that they've got very challenging technical charts, a lot of selling, a lot of big volume. So these bounces, I don't trust them. Looking for reversing candles. CCS, another one, making a move through the 50. We'll see if it holds. TRUE, this is TrueCar, testing underneath the 20-day moving average right now. And the last one I had was ZAYO. This is Zayo Group Holdings. Another one's up testing that 50-day. Also, you can see a lot of support right here at about the 25 area. Lost that on increasing volume. Now we've come all the way back up off that bottom from 20, gotten back up to 25. I think a reward to risk on the short side makes sense here. So those are the stocks that I've come up with for potential shorts this week. I would just caution, we want to see a reversing candle. I hate shorting, and I really only like to short if I believe that we are going lower and then we see a big reversing candle and I can manage my risk. So that's how I'm going to approach the week. But I'll go with NLS on the short side. I do think we're probably getting close to a top. Maybe we get one here in the next day or two. And then we could see some weakness again with the volatility picking up. All right, let's move on. We're going to head into the earnings spotlight. This earnings spotlight is brought to you by earningsbeats.com. Earningsbeats.com provides high reward to low risk trading candidates, and they'll teach you to focus on the combination of strong fundamentals, strong technicals. Learn to exercise the patience and discipline of an experienced trading service. Earningsbeats.com, better timing, better trades. Mr. Hopkins, Happy New Year. How you doing today?
Hey, same to you. I'm doing pretty good. How about yourself?
I am doing well. You know, as I was going through and just kind of reading that little sponsorship thing, I saw the focus on combination of strong fundamentals and strong technicals, but you've actually got change going on here with all the downside that we've seen in the market. We're actually, you know, I've been talking about maybe shorting some, just went through a number of short setups, and I suppose you're looking at the same thing.
Absolutely. You know, Tom, I'm like you. Don't like shorting. I think the majority of traders, you know, would prefer to be long or cash than short. But, you know, we saw some things happen recently, and I'm kind of with you on this, you know, recent move to the upside, sort of the same target range on the S&P. You have to remember, you know, just like when the market's strong, you pull back to key support levels and get your nice bounce. I could be very wrong, but I think that all we're seeing today is a relief rally. The one thing that's really caught my attention, you mentioned this before, is the VIX. The VIX is at 21. It's barely budged today, which is really strange with the NASDAQ up over 100 points. In my opinion, if things were really strong, I think the VIX would be down substantially. So the question has become, why is that VIX not budging? And I think part of it is that there's hesitancy. Remember something else. If people think Apple's the only company that's going to miss earnings this time, I think they're wrong. So I think what's going to happen is we're getting this bit of relief here. Could it last? Absolutely. But I think it's short-lived.
Yeah, I agree with you on the earnings. I think I don't think Apple is just the one company that's just going to come out and warn. We did have some others. NVIDIA warned, Micron warned, FedEx certainly had an awful report and guidance. So there's a lot. We're going to see a lot of that. And the question is, has it already been discounted with the huge drop that we saw in the fourth quarter? And now we're rallying back because the market's looking beyond that. It likes what it sees. I will say that the one thing that has really thrown, I'm going to pull up a chart here. The one thing that throws a monkey wrench into all of this for me is the employment numbers. And I'm going to go back and I'm going to do a long-term weekly. Of course, let's do monthly because they come out monthly, once a month. And I'm going to go back and let's go 20 years. And then instead of the RSI, I like to use the rate of change on the job. And so that's 12 periods. So let's take a look at what's gone on with employment. If you notice, we had a straight up move in employment into early 2000, and then things started to slow. And that's where you saw this rate of change coming down prior to the bear market really kicking in. If we go into 2007, the jobs report was going up, but you can see the rate of change was starting to drop back in 2006 into 2007. And then, of course, the whole market went down and jobs, took a big turn. Check out what's going on here. When I look at this, I don't see the jobs reflecting what the charts, what the S&P is telling us. The jobs continue to accelerate. And I think that's what really threw the market for a loop last week is the ADP report came out on Thursday much stronger than expected. And I was thinking, okay, that's a little bit of a head fake. Now let's get the real numbers on Friday. And then the real numbers were absolutely off the chart. And we got that huge rally in the market. So I think there is a little bit of hesitancy on my part to say that this is definitely going to be what I do think is that this is kind of confirming what I was talking about earlier, that this is a cyclical bear market, not a secular bear market. This is what led to a huge drop back in 2000 to 2002, 2007 to 2009. We saw jobs falling apart. We had a huge recession, blah, blah, blah. I don't think that's what we're looking at here, especially based on what we're seeing with the employment numbers.
Do me a favor, pull that VIX up.
Okay.
And again, I just want to point out that, because I follow this pretty substantially.
Right, this is a monthly going back to 1999. Do you want something other than a monthly?
No, no, that's fine. I'm keying in on where it is. Sitting near 21 right now. It's very strange to me, that the market's rallying the way that it is, and we're sitting at 21 because I still think people have a couple of fingers on the sell button, and I think anything that comes here's I guess the difference between now and maybe more recently. I think that if anything comes out that is sort of a surprise to the downside, the market's not ignoring bad news right now. And I think that when you start taking a look at some of these stocks that have made really nice moves in the past 3-4 days, that there's so much profit in there that I think traders won't hesitate to take that off the table. So I think it's going to be tricky going into earnings season for the market to retain this move to the upside.
Yeah, I think, I agree with you as far as the news goes. I think if the market comes out with bad news, I think because the VIX is elevated and the fear is still out there, I think we're going to see a pretty big reaction. And I would just pull up a stock like Amazon. I mean, we just saw Apple warn. What happens if after the bell today, Amazon warns? I mean, it's possible. Look,
absolutely.
The stock was trading at 2,000 back in October, and now, at the December low is down 1,300. I mean, that's 700 points. We're talking a 35% haircut in about 11 or 12 weeks.
Yes.
That's a huge drop, and the market foreshadows things. So don't be shocked if Amazon doesn't come out and say, you know what, we're not beating our numbers either. And after this huge rise that we've seen in the past week and a half,
absolutely
subject to a quick 200-point drop.
I think that's right.
Yeah, and I think we're going to see some of those disappointments. I agree with you.
Hey, a couple quick stocks quickly. I know you talked about one. This is on my short radar screen. Is XPO. Got really close today. I mean, it's closing in on its 20-day.
Yep.
Plus a little bit of price support up there near 60.
Yep. Gap resistance right here.
Yeah, gap resistance. You take a look at the volume on the selling on the miss.
Mm-hmm.
And look at
I think the miss was earlier. I think the miss was back here. I think this was I think there were some rumors coming out. There was a short hedge fund or something that was talking about the president of XPO.
Okay.
He had worked somewhere else previously, and apparently they found problems when they audited the company. So they were
whatever it was.
Yeah.
It was massive.
Yep.
And now it's moved all the way back. I think it's up 30-some% from there. It's coming on, strong resistance. I think this, just like if we're looking at the opposite of a high reward to risk to the upside, I think this is a high reward to risk to the downside.
I agree with you. It was one of my Monday setups. I definitely agree. The only thing I'm looking at, again, I think, getting back, you can see at the beginning of December, it actually went above the 20-day intraday and then closed down near its low. That's the kind of thing I'm looking for. I want to see the sellers kind of get control of it into the afternoon, and then I would be willing to go on the short side with a fairly tight stop. I think that there is a lot of potential reward to the downside. I don't know if it goes all the way back down to 45 because that could have been an unfounded report and so forth. But the stock definitely is downtrending, and a move back down, $5-7, maybe back close to 50. That wouldn't shock me at all.
Yeah, let me throw one in here, which is sort of interesting. We came in a little early in the short side, ERF, but it's setting up even better, for a short. But what I wanted to point out was the rules of the game in shorting are no different than when you're going long. You have to have discipline in terms of entry, exit, a stop loss, etc. And this is when we got involved a little bit early, to the short side after it made that bounce recently, and we got involved on the short side at 853 with a stop of 870. It stopped out today, but now you can see it's coming, up on the 50-day moving average, some price support, etc. But the key is we had a tight stop in case it went against us. It's no different on the short side, the long side. You're just not going to hit them all. So the most important thing is to recognize, but it doesn't mean you can't get involved again. So to me, if this stock continues to move higher, I think it's going to exhaust itself.
Yeah, I would be looking, I think it can get back up to about 910.
Yes.
This is where it came down. There was your reaction high back up here. And then you had the gap down with the increasing volume that started. Let me see if I can get out of this and see what that exact number is. That's the beauty. When I trade using price support, price resistance, I can nail it to the penny as far as what I believe is the key resistance area. Yeah, I mean, we closed at 906 on December 13th, and then we gapped down, opened at 889 on the 14th with volumes beginning to pick up on that selling. So I'll be surprised to see it close back up over 906. I think the closer you get there.
I think so.
Yeah.
And one last one, I'm sort of interested in your take on this one. This is MDB. If you take a look at NDB, you can see what happened on their earnings. And the stock recently got as low as $70. It's risen back now, where it's closing in almost on its high. It got as high as, I think, 92 and change. You see this as a complete reversal, or do you think this thing could stall?
I wouldn't touch this one. I mean,
okay.
if it was truly breaking down here, I don't think it should be back up near its 52-week high in this kind of a market. I mean, it's definitely an outperformer on a relative basis. I mean, yeah, this is an area where it's topped, so 90 to 92 could be a short area, but I would absolutely have my intraday stop in play here, because if it breaks out in a market that's this bad, imagine what it'll do if the market continues moving higher. So, this is one I like to see, the ones that have broken down and remain broken down technically, these that come rallying back. And I'll show you a couple. Twilio, this is a strong earnings chart, but look at this stock. I mean, here it is breaking out potentially to a new all-time high today. And the market, where's the S&P 500? 300 points?
Yes.
Points from
yeah,
its high.
Strong.
Same thing with SendGrid, SEND. Look at this stock breaking out. These are two of the strongest stocks in the stock market right now, Twilio and SendGrid. I'm careful. I don't like shorting the strongest of the strong.
I agree with that.
I want to short stocks that are underperforming. So,
Mhm.
stocks like that what was it, MDB?
Yes.
I wouldn't like it just because it's holding up so well on a relative basis.
Okay. All right, my friend.
All right, you got them all
Great.
in?
Got them all in. That's fine. That's enough for today. But anyways, again, and by the way, who was holding on to all these stocks when the market was tanking? The market makers were really accumulating, weren't they?
Yes, they were.
And boy, they know how to unleash, don't they?
Yes, they do. I talked about this back on December, like the 26th or 27th. I remember in my blog article, I said, first of all, the volatility index got up to about 36 or 37. And anytime you get the VIX up to that high, pretty much the kitchen's being thrown out, the baby's out with the bathwater. You can start to look for a major reversal when you get the VIX up that level. So, and we got that. The 27th or whatever, the bottom was in. And now we're getting that reaction high. And I've shown a lot of different bear markets, both the secular bear markets and also cyclical bear markets. When you get the volatility index to those high levels, extreme levels, you're going to get a nice bounce, usually 7, 10, 15, maybe even 20% in the market. But it's what happens after that really becomes important, because everybody starts to think, okay, now everything's good again. I'm going to start jumping in on the long side. And
Exactly.
About that carpet gets pulled out from under you.
And think about how many people exited the market in the panic when it was selling off. And now they're taking a look and saying, boy, maybe I got out early. I'm going to get back in just in time for the rug to be pulled out. That's what I think we're going to end up seeing.
Yep. And I think this bounce represents that opportunity. Again, I think it's a cyclical bear. So, the more I look at it, the more I'd be okay holding a little bit. But I still think that you could get hurt in the first 6 months of 2019 if, in fact, this cyclical bear market just lasts a little bit longer than the last few. I could see the average cyclical bear market since 1945 has been about 9 months, 8 or 9 months. And so if we say that we started in October, that takes us basically the start of summer. Sometime late spring, early summer, I expect we will have a bottom in. If we don't already have a bottom in, I think we'll have one in by then.
Okay, my friend.
All right. Always a pleasure to have
you,
John. Happy New Year.
Take care. Same to you.
All right. See you in a couple weeks. And there he goes, John Hopkins from earningsbeats.com, talking about shorting now. And I actually agree with, John and I talk a lot. I do agree that I think you have to wait to short. I think, if you look back at the market the last 10 years, we've had a few periods, a couple of corrections, couple of pullbacks, but it's difficult to short the market when you're in a 9-year bull market. And I know a lot of folks may be calling for a lot of weakness ahead. I just don't see it. I think we're going to see, potentially we could see another, from this level, I wouldn't be surprised to see another 10, possibly on the outside, 20% downside, but I'm going to say 10 to 15, maybe go back and test that recent low, maybe a little bit lower. And then for me, I'm going to be in on the long side. But I know that's different than a lot of people.
Yeah. I mean, I don't know. Right now I'm looking at short-term bullishness into the end of the week. But after that, I mean, I still am of the opinion we're in a bear market, but I think we should enjoy these little rallies that we get along the way down. And if you're still in, it's obviously, I mean, it's a place where you could now, move to cash in some of those holdings, take advantage of this rise.
Yeah, I think that the risk reward, I mean, if you're looking at it from a reward to risk standpoint, as we've rallied off the bottom now, we have a lot more downside with the volatility still high. We know earnings reports are going to be impacted. We saw what the market did in the fourth quarter. This isn't a shock. I mean, everyone was shocked by the Apple news. And I guess, yes, it was shocking because they hadn't done anything like that in 17 years. But when you look at their chart, I mean, technicals are telling us a story. And technicals were already, I mean, your dad wrote about Apple back when it was probably close to 200 and was warning everyone that, this could go a lot lower. And I think he threw out like 130, or I don't remember the number he threw out, but I know he was getting pretty darn close with that recent drop in Apple.
Oh, absolutely. We actually went over an Apple chart in the Decision Point show last Friday. So if anybody's interested in his opinion, go ahead and check that out on the Stock Charts YouTube channel, the Decision Point show.
Yep. And I would say I'm going to pull up the Apple chart. Of course, we don't have the chart showing right now, but I think it was probably back in sometime in late October, early November when he wrote about Apple and the fact that he thought it had broken down and could go a lot lower. Go back and, kind of look through those decision point blog articles. I think you'll find his chart.
Found it. I found his Apple chart. Here we go.
Did you find the article? Do you know what article, when the article was?
I don't remember which article, but if you go to the search and you do, Apple and Carl Swinland, you probably will find it. But this is the chart he'd been watching because it does these parabolics constantly, and then it goes down to the basing pattern, and that's why he was picking 130 because we had that big parabolic, and then of course it did. It dropped quite a bit, and we're getting close to that 130 mark now.
November 5th. I just found it.
Ah, there you go.
So he wrote about this on November 5th. Those of you out there who think that technical analysis doesn't mean anything, Carl didn't. He wasn't talking to Tim Cook about things going on at Apple. I mean, he's looking at their chart. November 5th, Apple had broken down below prior lows and was trading at 200 at that time. And I remember him saying in the article, I'm going to see if I can find it. He talked about it could go a lot lower.
Exactly. Because again, it's that parabolic. And if you want to count it off of this low and you want to go down to the basing pattern from back here, now you're talking about, the 185.90 right here. So that would be, I would imagine, what was his next downside look after 130.
At 200, he said his downside, the obvious downside target to him was 127.
There it is.
That line you've got drawn across there. And you can see how far Apple has declined and how dramatic that decline's been. That was one of the best calls I've seen in 2018. So you can definitely pass that along to him. I thought that was an awesome call.
Yes, I will definitely let him know. Yeah, it was great to have him on the show Friday. Really enjoyed it.
Yep. Well, anytime you make a call like that, especially on Apple, which I think just about everybody would agree is, if it's not the most popular stock out there, it's certainly up there with Amazon, a couple others. But, to say when a stock's at 200 that it could go to 127 and to see it almost there 2 months later, that's pretty impressive.
Yeah. He
anyway.
always impresses me.
All right. So, yes, I know. So what do we got for the 10 and 10?
All right. Well, here you go. This is what we're looking at. I thought it was interesting. Look at all these in the improving category, and even these ones in lagging that our viewers have looked at and picked. Notice they're all hooking up toward that northeast direction, which is what you want to see. So we will likely be looking at some of those. Go ahead and get your votes in. The most popular will be the second symbol, but the first one is HP.
All right, HP. Let me pull the charts up here. All right. Okay, here is HP. Now you can see the huge selling that took place in December along with the overall market. You can see the big breakdown here going back. I'm going to lengthen this just a little bit. Let's go back a year. Yeah, definitely 56 to 58. You can see that's where the 50-day is. So let's go ahead and annotate this, keeping in mind those two key support levels. So you've got your intraday there, kind of your closing, maybe about right there. That was your support. We lost it on very heavy volume. So if we get back up to 57, I would be a seller. I think that's going to be a key area. But I'm not sure we get all the way back up there on this rally, especially if the market turns over. You're going to want to watch the market. If the market begins to roll back over to the downside, I think HP drops and fails to get through the 20-day. The positive, the one big positive here for me, I think this is an energy stock, right? HP?
Yes, Helmerich and Payne.
Yeah. The one thing I think that it's got going for it is I do think that crude oil prices could pop into the 50s, into the low 50s per barrel. And if that happens, we might get through that 20, start making a run for 56, 57. But I do believe one of these two areas is going to hold the stock, and we'll see more lows coming down the road.
All right. The most popular in the chat room is the materials sector Spider, XBI.
Great. I like the breakout. believe it's temporary, but I do like the breakout. Pretty good volume on this move to the upside. Let's watch a couple key areas on the XBI. If you noticed before, we had pretty good support back here in April. We lost that, and then the reaction highs came back through and established right at about 85.5, which was put a double top in there. So I think this is one, if it reverses and leaves a long tail and we get a big reversal and close down at the bottom today, I think the top is in. But if we finish about where we are today, I think we got more upside. And I would be looking up to about that 82.5, all the way maybe to 85.5 area. And I would be looking for a reversal somewhere in that area for a move to the downside.
All right, excellent. Let's see, the next one I have for you, kind of in the material, well, it is in the material sector, AK Steel, AKS.
All right, AK Steel, nice move back through the 20. We've been down below the 20 now for the last couple of months, so that's a good development. Also, look at the volume coming in on Friday, and decent volume today, maybe not quite as heavy. Trying to look for, key. I mean, I think we have a shot at running back to $3 with the declining 50-day moving average. And I'm looking at this prior low down here, right around $3. Kind of held up there and then fell apart. Decent volume on that selling there. So maybe we continue there. We do have some reaction highs coming in at 274. This, if we can get through 270 to 273, somewhere in that, wherever these intraday highs are, I think if we can set a new high there, I think we have a shot to run for 3. Be careful reversing candles and a close back below that 20-day moving average, though.
All right, let's see. Next one up, PATK, Patrick Industries, building materials industry.
All right. Well, I know home builders have certainly perked up, breaking out above the 20-week moving average. We'll see if that holds this week. So I think we're probably going to see some stocks maybe within that area that are doing well, and PATK seems to be like maybe one of those doing that. Very similar to what we just looked at on AK Steel. Couldn't get through the 20-day, hasn't been able to do that in the last 3 months. Finally doing that. So the question is, where do we go? Well, next test would clearly be the 50, and I think we got some gap resistance that we want to kind of watch for there as well. Here is where we gap down and check out the volume and also the reaction high after the gap down the next day. We failed at 37.5. So I do think that the further we rise, the closer we get up to that 36, 37 area, the more I like it on the short side. And like just about everything else I've talked about today, watch for reversing candles, because if we start to see, this is looking pretty bullish right now, but if you get a big pushback to the downside at the close or one of the days coming up this week, get a big reversal, that could signal the start of another downtrend. So just maybe be a little careful here.
All righty. How about Netflix? Talked about Apple.
Yeah, Netflix has had a huge day on Friday, continues to strengthen today. This is a really nice move. I mean, this is one of those charts that kind of argues for maybe the bottom is in. Netflix, which was 230 less than 2 weeks ago, is now almost 320. So as fast as it was going down, it is recovering. This has been a very, very impressive rally, and I could draw trend lines and so forth. It's gone through that. It's gone through moving averages. I think probably the big selling began early in November. So my guess is, and what I would look for if I was trading this on the long side, is maybe somewhere in this area. We've kind of entered it already. There was your prior low, double bottom, breakdown, and then the rally back up to about 325, 330. So I think somewhere in this range, 315 to let's call it 330, I think we'll probably find a short-term top on Netflix. Moving back down, we'll see whether or not we can hold that rising 20. So another one, because it's risen so much, I'm not interested in jumping in and chasing these stocks. Instead, I'd look for reversals for possible quick short trade.
All right, let's see. Next one up, Five, F-I-V-E, I believe. Yeah, that's 5 below.
Yeah, this is in the retail space, I believe, and the retailers are really moving today. Five doing very well. This is a stock that had gapped up. You can see the gap ups in June and September, earnings related. This was on my strong earnings chart list for a while. And then the last one, I believe, it was one of these, I can't remember which one of these was the the earnings report day. But anyway, we did see weakness. Of course, the overall market, there was just not much going up back then. But we failed to hold a major support level at 95, but quickly came back up and held it. You can see after gapping up in June, we pulled back, hit 95. We hit 95 again in July, August. We hit it again in early December. And then we broke down an increasing volume, but we quickly came back up and were able to hold that level. So I'm looking at this as kind of a wide support area in the event that the market does roll over and go back down, goes back down to where we were recently. I don't know if 5 goes all the way back down there, but it is a volatile stock. It certainly could. Watch again for reversal. And actually today, if this one were to reverse, because we are at a pretty big gap resistance, if we leave a tail above the gap resistance and come back down and close below it, today's high could mark a short-term top. So another one to be careful with, but I'm sounding a little bit like a broken record with the market, moving up as much as it has been.
Right. It's hard to argue with. All right. How about the artificial intelligence ETF? It is AIEQ.
AIEQ.
Okay. AI-powered equity.
Yeah, I think you're coming up on a major resistance level. This one on the chart I think is pretty easy to see. We've had multiple bottoms right at 23. We saw it all the way back in February. We saw it again early April. Nearly there in October, tested again in November, hammer there early December, and then we broke down. Now we're coming back up to test it for the very first time. Usually those tests fail, so I'm going to say it's getting close to a short.
Okay, interesting. Next one up, and we briefly discussed it, Roku.
Oh my gosh. Yeah, we talked about this one before the show.
It was requested, so I thought it would be a good time for you to get into that.
Yeah, well, it would have been a good time for me to get physically into it about 2 weeks ago. Yeah, Roku I like the stock. I actually have Roku, and I just like it, their platform, and they had been growing subscribers like crazy, but like everything else, these growth stocks just got hammered in the fourth quarter. They came out today, and I think their subscribership is expected to be much better than expected, blah, blah, blah. Stock is up 22% today. I think, I'm going to wait and see if I can get it cheaper. Obviously, I don't want to chase this kind of a move, but that was a pretty bullish. Those were bullish comments. So I think the two areas to watch on a pullback are going to be the bottom of gap support and the top of gap support right here. So let's look at 34 to about 37. Down the road, if the market bottoms or goes back down, retests, and you've got the stock close to that area, that might make sense for a good reward to risk trade on the long side.
All righty. Next one up, we looked at Roku. How about Kohu? COHU.
All right. You're going to give me another one that rhymes to end it?
Yes.
All right, Kohu. Got a trend line, clear trend line in play that we haven't yet tested. I think also the volume trends, I think pretty obviously have been weak. But if we come down and just kind of draw the line, something like that, you can see the trend. Not going to be exactly the same line. No, it's pretty darn close. Yeah, I think we're in a down channel here with volume trends so weak. So the closer we get to, say, 17.5 to 18, I think that would be an interesting area. That was the reaction high, by the way, 18. You got the 50-day moving average, 1778. The trend line comes down and intersects right around that territory as well. So a little bit more movement to the upside, I would be a short. Look at the volume trends. Big on the downside, lightening as you move higher. I think that this is probably a stock looking to roll over, probably sooner rather than later.
All right. Last one, Darden Restaurants.
DRI?
Yes. I figured you knew that one. It's one
Yeah.
we do a lot, right?
Yeah, shows how boring my life is. I think I know every stock ticker symbol. All right. Well, this is another one that went just a little bit below a key gap support area. This is in the restaurant space. Restaurants had been doing very well, but of course, everything got hit in the fourth quarter. Stock is starting to rebound, though, getting back above the 20-day moving average. This is a tough one because I like the group and I like the stock, but it has rallied now about $8 or $9 off the bottom, and we're getting close to some overhead resistance near the 50-day. And also you can see a number of recent tops going right in through here, all of these reaction highs in December at about 106, 107. So I think we're going to run into some, I think we have maybe another 2% or so to the upside, kind of like the overall market. And then I think we're going to struggle. Reversing candle, I think likely would send us back down. This is one I'd probably be interested in, but I'd have to see a little bit of a pullback first.
Okay. And that actually does complete our 10 in 10. There you will find all of the symbols right there. I will have them up in the Market Watchers live chart list at the end of the show. If you want to go there, just go to the blogs tab, click on the Market Watchers live blog, and that's where you will find them. So it'll be interesting to see what is going on in the market right now. It is time for our final market update. So let me go ahead and get started with that. All right, make this bigger. Okay, so what are we looking at right now? Markets are up as we've been talking, and they're really not pulling back yet or pausing. We can see that all of the large cap indexes are on the rise. We have the S&P 400 also keeping up, as well as the Russell 2000 and small caps. Canadian markets started off a little choppy, but are rising nicely. The Treasury yield rising, but seems to have hit a pause right now, currently reading at 2.682%. The VIX is moving lower. I'm expecting to see it move even lower. It is at 21 currently. UUP gap down and now just consolidating sideways. Gold gap up, did pull back quite a bit and is now moving sideways. So I'll be looking at that gold chart shortly. USO is up on the day, almost 2% to the upside. Last reading for USO is $10.38. And TLT is down slightly, reading 121.93. And that's all I have for the final market update. What do you have to display, Tom?
All right. Again, for anybody maybe that came in late, I just want to say this rally obviously has been huge. This is what we expect off of a VIX reading that was at 37 down here at the low. Gone back and looked at a lot of reaction rallies after these bear market lows have been established. This is not unusual. This is very normal, what we typically see. Getting back through the 20-day is certainly one positive for the market, no doubt about it. But keep in mind, 25.82 was that bottom. 25.81 actually was the low close back in February that was tested again in April. And you can see almost tested again back in the beginning of December before we broke down on the increasing volume. So as we get back up, I think we're getting very close. Watch for a reversal. And the other chart I'll show you here on the hourly chart on, well, not on the Dow, but on the S&P, that this move right here back on December 19th, this is when Fed Chair Powell came out and basically said, we're going to raise rates. And, oh, by the way, we still have 2 more rates coming in 2019. And the market said, well, I don't think so. And now the Fed has backed off of those comments, saying they're going to continue to watch data. But notice the move that we're seeing now. We're getting very close to where we were at the time when all of that selling began, and the huge selling went all the way into Christmas Eve. So this is an area I'd be watching for potential reversal. If we can get through this level, then I think we probably have it, like I said earlier, maybe another 2-3% to the upside before the next key area. But I'm thinking 25.81 is going to be really tough for the market. We'll see.
All right. Well, let's see. It's time for the sentiment update. I have some very interesting charts to share with you. So let me go ahead and pull those up right now. All right. Make this bigger. All right, so we have our sentiment update for January 7th, 2019. And the charts have been really interesting. I haven't had a chance to really peek at them over the holidays, so it was very interesting to look at them today and see the changes that have occurred since December 24th. We're going to look at the 10-day moving average of the put-call ratio. The American Association of Individual Investors does a poll, and we'll be looking at the results for that. National Association of Active Investment Managers, NAME, we'll be looking at their exposure. What are the money managers doing with their money? RIDEX ratio, really interesting chart. I think it makes sense. When you'll see it, I'll explain that one. Wall Street Sentiment Survey, those results are now in from Friday's information that we got. Everybody takes the market timers. We take a survey at the end of the market day on Fridays, and I have all of the results for that. We will look at the VIX a little more closely, and finally I will finish off with some gold sentiment. So we have a lot to cover. Let's go ahead and get right on into it. I'm going to start off right now with the OEX put call ratio is what we're looking at right now. So that's the OEX price pattern on the top. What I like to look for with most sentiment and really most charts is you're looking for those oversold and overbought readings. And one of the things I want to be sure you see is that I do invert the scale, because to me, the higher the put call ratio reading is, actually the more bullish it is. And that means oversold to me. And opposite, of course, goes to the upside. So right now, what I want to point out is that we had a bottom that came in, and you can see we started to turn back up after that December 24th, terrible move to the downside. We started at that point, the put call ratio started to rise with price off of that bottom. They are still rising, those ratios. So I would consider still in a short-term bullish position. And actually, when you look at this chart, which is over 2 years, I think it is 3 years, you can see that we haven't seen these lower readings since then. 3-year chart. So in the last 3 years, we haven't seen these low readings on the put call ratio. We're now just getting into what I would call extremely oversold territory. We just hit very, very high extremes. And now we're still in extreme territory, in my opinion, as far as the readings go for the put call ratios. So they're all rising here. I still think that that looks good for the market in the short to intermediate term. All right, the AAII investor sentiment. This chart, not as interesting as I would have liked to have seen, but you can certainly see that the bearish activity is continuing as far as the readings go. But a third out there are bullish. And, to me, a fully neutral reading would be almost everybody at a third bulls, a third neutral, and a third bears. Would be, obviously a distribution in the middle. And so when I see a bullish rating there of 33, 1/3% or 1/3 of the people surveyed, while that's somewhat low reading right now, it's not accompanied by a particularly strong bearish reading. I mean, 42.8 is still, a pretty high percentage of bears. But when I look at that ratio, it's just not telling me anything exciting. We're just below that 1 measurement for the bull-bear ratio, meaning we have, an equal number of each. We still certainly are seeing a little bit more lopsided look, because we are at 0.75 as far as our bull-bear ratio goes. So we are on the bearish side, and it does seem, though, that we might be starting to move a little bit more bullish. But right now, there's still a preponderance of bears, and I think that's positive in the short term. Look at the exposure for the active money managers here. And what I noticed is, we get these low exposure readings. Typically, they come right before a rally. Right now, unfortunately, though, we're looking at really down the middle kind of readings. It's still low exposure. If you look at this 60 line and you come across, it's still pretty much, it's still low-ish, but it's not that high either. So to me, this is really a neutral reading. I do see an increase in exposure over the past few weeks, and I think that could be considered somewhat bearish at this point, with people getting more bullish. But in the short term, these guys tend to be right. So I would say going into the next week, they've increased their exposure. I think, going into this week, I should say, I think it's looking pretty good in the short term. All right, the Wall Street Sentiment Survey. This chart pretty much was a eyes wide open chart when I looked at it, because of the bull-bear ratio for Wall Street Sentiment. Now, this is wallstreetsentiment.com. There is a poll, and market timers get this poll, and we put in our thoughts as far as what's going to happen at the end of the next week. So the end of this week, we have 72% of the timers are bullish right now. And look at this ratio. We haven't seen a ratio this high in, at least about a year, 2 years, almost 2 years. So it's very lopsided to the bullish side, and that typically would be considered bearish for the market. But I think that we're going to eke out, if you look at some of these high readings that we've had before on the ratio, we have had some moves to the upside where they've been, market timers have been, on it. Look at this one in particular as we were going into that correction. Obviously, this one didn't work out quite as well, but when we had this extremely high bull-bear ratio, we still ended up, we actually came off of that with a nice upside move. So I think that looking at some of these extremes, while the market timers aren't always on it, they don't always come through for the next week. I think right now, just given the corrective mode, that this sentiment is somewhat lopsided, certainly to the bullish side. And generally, I would look at that as being bearish. But in this case, because it is so lopsided, and that there is a lot of the timers on the side of a rise at the end of this week, including myself, I'm going into this week short-term bullish. And here's one of the reasons why. I'm going to show you the VIX chart next. This is why I am short-term bullish, which is why I gave the that poll answer of moving higher at the end of the week because of the VIX. The VIX is continuing. This is an inverted scale. So when VIX readings get lower and people get less concerned and more bullish, that is considered overbought to me. So that's why I flip it. And so the readings for the VIX continue lower. People are getting more and more comfortable, a little bit more complacent, I suppose you could say. But at a reading of 20, I wouldn't call that complacency. I would call it a sigh of relief more than anything. But we still have room to move to the top of that Bollinger Band. And I would suspect we're going to get some more upside in the shorter term. People are going to start falling for the idea that this is the end of the correction / bear market, however you want to look at it. I've been warning people to beware of that kind of hype that you're going to hear and see, because I suspect in the intermediate to longer term, we are going to bear some more downside. But when we get these upside moves, time to take a breather, take advantage, maybe move to cash on some things, maybe move a little bit more into the hedge department or short department. But I see some more upside in the shorter term for this week based on the VIX. So I am bullish going into the end of the week. All right, let's go ahead and look at the RIDEX sentiment. RIDEX ratio, the RIDEX funds, we keep track of them. They were a group of funds managed by RIDEX, which is why we call it RIDEX, but they're now managed by Guggenheim. And it's really interesting. It's a basket of bull funds, bear funds, and then they also tell us what the cash assets are the end of every night for those funds and, the cash holdings, money markets. So it's a really great tool to see where people are, what their sentiment is based on real money. We looked at polls. We looked at, market timers are very bullish right now. We looked at, the individual investors as a whole with the AAII. But this is what people are actually doing with their money. And so I find this chart to be especially useful when I'm doing my sentiment analysis. So what do I want to point out about this chart today? Well, number one, I think the one thing that's very obvious here is the major move into cash. I was one of them. I moved everything into cash mid-December. So I'm not surprised to see this big move to the upside as far as cash assets go. What I found interesting, though, was the decline, the steady decline since, if you come up here, since we found we had that terrible day on the market on the 24th of the 24th on Christmas Eve, that's when everybody started to actually look at cash versus the bear funds, because the bear fund assets have been moving down as far as where the money's going. So I am looking at this huge decline in the RIDEX and bull sector funds to a level we have not seen in the last 2 years. And we're at a high as far as cash in the last 2 years. And although we aren't at a high for the bear funds, we're pulling back from that, but we're still in the high side of readings for, since December, mid-December on. This is a really high reading for the amount of assets in the bear fund. So what I would get from this is that we are still looking at very bearish readings in terms of all of the assets moving to cash. But we're starting to see this decline in the bear assets. And so to me, I would say that people are getting obviously a little less bearish and finding more interest in the cash side of things. But we are losing a lot as far as the equity assets, the bull funds. So really, ultimately, I think this is just a look at, like what I did. A lot of people moving into cash, not really ready to, after a big decline like this, to go and continue on the short side. People moved out of those bear funds. Makes sense as price was moving up. But what is really important is the increase in cash and the decline in the equities. And that tells me that we're looking somewhat neutral to bullish for the market at this point, because sentiment is contrarian. All right, last one real quick is the gold shares chart. I've been looking to get into GLD since, mid-December, and I sure wish that I had. I haven't yet. I'm waiting for a little bit of a pullback here. What I wanted to note was the premium and discounts. That gives us our sentiment for gold, and it's been pulling back. We're still seeing discounts, though, and that is still bullish for gold. I'm really surprised we're not getting to premiums after getting to this level right now on GLD. All right, so that concludes the sentiment portion. I'll give you just a quick little recap, because I know we're down to the end here, and we do want to look at the poll for today for sure. So here I will have these charts up, these PowerPoints in the Market Watchers Live blog. Of course, you can always pause it and look at it that way, but those will be up there so you can get that look. But do we have time, do you think, Tom? Real quick look at that poll?
Sure. Yeah, let's put it up. Yeah, we got 50% thinking it goes higher, 36 lower, 14% mostly unchanged. I think we're getting awfully close to the 2581 level, so I'm going to go lower. But I do recognize, even as if you were thinking about shorting, if it does get through 2581, I think it's got another 2 to 3% to the upside still possible before we hit that 20-week moving average. So I go lower.
Yeah, and interestingly, I'm going higher. That is really unusual. If we're different, it's usually the opposite way. I was kind of in the mostly unchanged category too, as I was looking at it, but I ultimately voted for higher. So interesting.
Yeah, so we're almost complete opposites. Short term, you're bullish, but longer term, you're bearish. Short term, I'm bearish, and longer term, I'm bullish.
Right. But, that's what makes us such a great team.
Yeah, one of us is going to be right.
That's exactly. So gives everybody a nice look at everything. I wanted to, I guess we don't have too much, but of the Monday setups, are we actually going to make those trades? Somebody asked, and I would say no. For me, I'm still holding cash.
I'm not right now, but as I mentioned, if we get false breakouts on not just the pick of mine this week, NLS, which is a short pick, but any of those that I brought up and looked at, that, yeah, they're all getting close to key areas where I would short if I get a reversing candle, especially if the overall market looks like it's topping and we reverse. So
Cool.
Something to keep in mind. All right, there's our upcoming schedule as we move forward. As we're getting ready to wrap up the show, I do want to just tell you the Dow Jones Industrial Average currently up 228 points, NASDAQ up 109, and the S&P 500 is up 32 points, 2564. All right. I want to thank everybody for joining us today. Please remember to complete the survey as you exit. It's located below the video player. We'd love to get your feedback here, what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everybody. Hopefully we'll see you back here tomorrow. Happy trading.